Hi folks, I hope you're doing well. Thanks for tuning in. Today I want to finish off on income engine 3, that being capital. In my last video I talked about the importance of developing a structure that helps you allocate your capital, and more importantly a structure that helps you identify asymmetrical opportunities for allocating your capital. And I thought I'd just end off that discussion today by discussing risk, because I think a lot of people misunderstand what risk is, and once you have a deeper understanding of what it is, it will hopefully help you to identify those asymmetrical opportunities a lot easier. I find that a lot of people, when they think about risk, especially when it comes to investing, a lot of people think risk is volatility, and it's not. The prices of, when you buy an asset, essentially we said you want to buy an asset which is something that generates an income, and that's one of the strategies for creating wealth through investing. But when you buy an asset, you can't guarantee the value of that asset, whether it's stocks, property, or whatever you may be into. The price of that asset going up and down, that's not the real danger. The real risk when allocating capital is not volatility. The real risk is losing capital that you can never recover. The real risk is losing capital that you can never recover, or perhaps a better way of phrasing that, the real risk is making a mistake that you can never recover from. Permanent capital loss, or a mistake that wipes you out, whatever your investment strategy is. Risk is not about discomfort. In fact, when you're trying to create wealth, when you're an investor, when you go on this journey, you need to be, whether it's growing a business, whether it's investing in stocks, whether it's being a landlord, whatever your journey may be, if the aim is to invest and create wealth, you need to be comfortable with discomfort. So risk is not about discomfort, it's about permanence. Temporary losses can be recovered. Permanent losses cannot. So when we're thinking about risk, it's not about discomfort, it's not about the price of our assets going up and down, it's about permanence. It's about making a mistake that you cannot recover from. This is why the first rule of wealth is very simple. Avoid ruin. I always say first do no harm. Okay? At the core of any capital allocation strategy when you're investing is avoid ruin. And whatever structure you develop for assessing risk and allocating your capital, at its core, it's avoid ruin. First do no harm. Because once capital is destroyed, compounding stops. You remember in my previous video I said that is the whole point of compounding. The structure or the strategy is not to get the highest return or look for the best investment. Compounding is about developing a structure that gives you sustainable returns. It's about return and return and return. So we're not looking for the highest return, we're looking for the highest return that we can sustain over the longest period possible. And that's why I say the first rule of wealth is to avoid ruin, is to avoid that permanence, making mistakes that you cannot recover from. Because once capital is destroyed, forget about compounding, there's nothing left. Volatility feels like risk because it's visible. Whatever you invest in, think of volatility, like I said, as discomfort, Here I might be talking about stocks, but for someone else, the investment strategy might not be stocks. Like I said, it could be building a business or buying property, whatever it may be. There will be discomfort, there will be volatility. There will be good times, there will be bad times. And volatility feels like risk. The discomfort feels like, oh, what have I done? Or I'm doing something wrong, because it's visible. But that is not risk. In many cases, volatility is just movement. Volatility is just movement, and what I mean by that is it's part of the journey. As soon as you try and say, I'm going to create wealth, you're inviting volatility. It's just movement, it's part of the journey. Real risk is overexposure, it's poor decisions, it's lack of structure. Most people don't lose money because markets move, especially moving down. They lose money because they react to those movements. Or even a better way to phrase that, they lose money because they react to those movements without a structure. They panic, they chase, they concentrate without understanding. This is why understanding what true risk is so important. This is why risk connects directly to asymmetry. You're not trying to avoid all losses. Whatever your investment strategy is, you cannot go into building a business, building an equity portfolio, property portfolio, whatever it may be, and say, I want to avoid all losses. Losses will come. There will be bad times. You're not trying to avoid all losses. You're trying to limit downside while keeping exposure to the upside. You are trying to develop a structure that allows you to survive your mistakes. Before you deploy capital, you need to ask yourself, what is the worst case scenario? I'm doing this. What is the worst case scenario? Can I survive that? Does the upside justify the risk? If the downside can wipe you out, can take you out, it's not an opportunity. Wealth is not built by taking big risks. It is built by taking risks you can survive repeatedly. Wealth is not built by taking big risks. It is built by taking risks you can survive repeatedly. Compounding. That's what compounding is. It's not about avoiding risk. It's about understanding what risk is so that you can stay in the game long enough to win. In my next video, I want to touch on time, your greatest asset, the real driver of compounding, and how time can help you manage and limit risk. Thank you for watching.